Hi, do you wonder if your house is considered an asset? Or were you told it is a liability since you have to make a mortgage payment every month? Well, in this video, I will explain how house is classified from an accounting perspective. But first, let's take a look at the balance sheet equation. Asset is equal liability plus equity. I will break down each component first. Asset. Asset is everything that an individual or a corporation has in his possession. Asset should have an economic value. It can provide benefits now or in the future. An example of an asset can be cash or manufacturing equipment that you can use right away. Account receivable is also considered an asset, but it won't have any values to you until you physically receive cash from the customer. Quick tip: if you look at the balance sheet, items are sorted based on liquidity. At the top, you will normally see cash as it can be used right away. At the bottom of the list, you will most likely see items like buildings, lands, or goodwill, something that is hard to sell or liquidate. Liability. Liability is financial debts or obligations, something that you owe to other parties. You are obligated to pay money or provide services in the future. It can be account payable, note payable, or long-term debt. For example, you purchase raw materials from a supplier with a payment term net 30 days. That means you will receive raw materials today, but only obligated to physically pay 30 days from now. Equity. Equity represents the value of the company that belongs to shareholders. It can be stocks or retained earnings. According to the balance sheet equation, equity is equal asset minus liability. If your company has $100 million worth of assets and you sell it to get cash, then you use it to pay off your liabilities, let's say $70 million, then you will have $30 million left in hand. That represents value of equity. If there were 3 owners in the company and each has 1 share, then each of them would receive $10 million. Now, let's go back to the main question. Is your house an asset? Or perhaps a liability? Or even equity? So what happens when you take out a mortgage to buy a house? Let's pretend a house is worth $500,000. You have $40,000 in cash for down payment. You go to the bank and borrow the remaining $460,000. Now you purchase a house with $500,000 cash that you have and receive a house with the same value. How does your balance sheet look like now? You have an asset, in this case a house, $500,000. You have a liability, $460,000, the amount that you owe to the bank, and the remaining portion, $40,000, is equity. That means, although you have a house in your possession, you only own a small portion of it. Bank has more ownership of your house than you at this moment. So what happens when you make a mortgage payment? Let's say you make a payment of $3,000, $1,000 in interest payment and $2,000 in principal payment. Let's ignore the interest payment for now as it does not affect our equation. However, the principal payment does. It reduces our liability down to $458,000 and increases our equity up to $42,000. If a house does not change in value, we sell it for $500,000 and then pay back $458,000 to the bank. We will be left with $42,000. So what is the house? The house is technically an asset. But what you need to care more about is how that asset is distributed between liability and equity. A person with $1 million house and $900,000 mortgage is just as rich as a person with $100,000 in cash. Thank you for watching and see you in the next episode.